In this video I'll be going over the concepts and principles for the final exam. One of the things you'll want to know for the final is the difference between periodic and perpetual inventory systems. You'll want to know the fact that IRS forbids the use of last in first out inventory costing method, as well as you'll need to have a pretty clear understanding of the impact of any inventory errors. So for example, if inventory is overstated at the end of the year, that means cost of goods sold that year was understated, and therefore income was overstated. So that's the impact of inventory errors. Know the characteristics of asset retirement obligations, and you may recall that these are anticipated expenditures that will result at the end of a project, for example, in the life of a project. And so you will begin to recognize some of these expenses throughout the term of the income-producing years of the project, so that when the project ends, you will have the funds available to pay these asset retirement obligations. An example I use in class is with a company I work for, where we build these large wind turbines, and we knew that at the end of the 20-year lease we'd have to restore the land to the original condition. And so all the expenses that were incurred to return the land to its prior condition were accreted or were accounted for throughout the life of the project, or in this case throughout the 20 years. Know how and why freight in is not expensed until inventory is sold. So just kind of review the fact that freight in is generally capitalized in the inventory account until that inventory is sold. And review the present value of non-interest-bearing notes, and that they must be considered when financing assets. And this comes up in a question on the exam where they forget that the valuation of the note, for example, must be discounted to its present value, and then the discount has to be included in the journal entry. So what is missing in the problem is the fact that they did not include the discount on note payable when they made the journal entry. So you may want to review those concepts. I'd also review the calculation of losses on the sale of property. A pretty straightforward calculation that we've discussed in the past, where if an asset is sold at a price below its book value, then the company would have to record a loss. Know what costs to include when buying fixed assets. So any cost, for example, to set up a machine, test it, get ready for its use, would all be rolled into the purchase price of the fixed asset, and that then becomes your depreciable base once you've netted out any salvage value. Know how to account for changes in the estimated life or residual values of machinery or other fixed assets. The calculation of the dollar value LIFO method for measuring any inventory and cost of goods sold. So you may want to review just the concepts of that. Know how to estimate inventory using the gross profit method. So I have a demonstration for you to refresh your memory on that calculation. And in this case, we have beginning inventory of $250,000, and I changed that value from the exam. We had purchases of $875, and we had sales at cost. So you're going to have to reduce the sales at retail to sales at cost by multiplying the sales, which is given, by 1 minus the gross profit percentage, or 40%. In other words, the cost of a sale is going to be 60% of its retail price, 1 minus 40%, times this gross sales. And that gives us the cost of the sales. So to get your total estimated ending inventory, you'll take your beginning inventory, add your purchases, and then deduct your sales at cost. And that will give you your estimate of ending inventory under the gross profit method. I would also know the components of the retail portion of the cost to retail ratio under the LIFO retail method. So for this, you'd want to refer to page 474 to 476 in the text, and this will show you, based on the choices you're given in the exam question, which of these components are included in the cost to retail ratio calculation and which are not. You'll also want to study how to value inventory using the lower of cost or market rule. There are two steps to this process. One is to determine the market value and then compare that market value to the cost and select the lower of the two. So we have an example of the lower of cost or market as well. All right, so here's a situation where we have some skis. Selling price of $180,000, cost of $128,000, replacement cost of $120,000. Commission is going to be 10% of the selling price, and the normal gross profit ratio will be 20% of the selling price. So remember I said step one is to determine the market value. So you're going to select the middle value from the following. One is going to be your ceiling, which is your net realizable value. And you might recall that the calculation of this net realizable value will be the selling price of $180,000 minus 10% of $180,000, which is the sales commission. So take the sales and then deduct the commission on the sales, 10% of $180,000. And it'll give you $162,000. Then you need to calculate the floor, which is what you just calculated, the net realizable value less the normal profit margin. So in this case I took $162,000, the NRV, net realizable value, and then I deducted 20% of the sales price of $180,000 because the normal gross profit ratio is 20%. So the NRV less 20% of the selling price will give you the floor. And then finally the replacement cost is $120,000, and that's given to you. Now we're going to compare these three values, and we're going to take the middle value. And in this case $126,000, the floor happens to be the middle value. And then the second step, this step two, is to compare the lower and select the lesser of the two. And that is the lesser of the $126,000 you just calculated or the cost of $128,000. All right, so we're going to compare $126,000, which is our market value, to our cost of $128,000 and select the lower of cost or market. In this case it'll be $126,000. And the next question you'll need to be familiar with is the purpose of the fixed asset turnover ratio. So the fixed asset turnover ratio just tells you the relationship between the assets and income. Assets generate income, and this ratio tells you that the fixed assets generate revenue. So we'd want this fixed asset turnover ratio to be quite high because it's saying that these fixed assets then are generating a lot of sales. You'll want to know the impact of impairment loss on the financial statements. Pretty straightforward concept. You'll not want to be familiar with the journal entry for a purchase under the perpetual inventory system. Remember, under the perpetual inventory system, when you buy inventory, you debit directly into the inventory account. Then you'll credit either cash or accounts payable. Know how to account for research and development costs. Generally, they're expensed. Know the calculation of depreciation and book value under the straight line method. So calculation under the straight line method here. First, we need to know the cost of the asset. I changed it to $50,000. The residual value or salvage value, $5,000. The life is 4 years. So the annual depreciation would be $50,000 minus $5,000 divided by 4. So that's your annual depreciation. Then it also wants to know what is the book value at the end of the second year. Well, the book value at the end of the second year will be your $50,000 minus $11,250 minus $11,250 for 2 years. And once you take the $50,000 and deduct the 2 years of depreciation, you'll wind up with your book value at the end of the second year. Other characteristics of the conventional retail method: how to value assets that have been acquired by the issuance of stock. Know that manufacturing costs are categorized as either product costs or period costs. So if the asset, for example, is used to actually manufacture a product directly, like a machine that makes the parts that you're selling, those would be product costs. If you're talking about indirect overhead that indirectly supports the manufacturing process, that would be a period cost and would be expensed right away. Know the calculation of ending inventory and cost of goods sold under the first in, first out method. And I have a demonstration for that calculation as well. So in this case, a company uses the periodic first in, first out method to account for inventory. And so I just repeated the data that was given We had beginning inventory, we had 2 purchases, and then the cost is listed to the right. And then we had sales, 2 of them. First we sold 400, next we sold 600. And using the first in, first out under the periodic method, we just need to calculate what the cost of goods sold are for each of our sales. So if I drill down into the first of our sales, 400 units, remember first in, first out, I'm going to take these 100 units at $2,800 because that's my first cost that I can grab in this sale. But now I need 300 more. So I'm going to take 300 of the 400 that were purchased at $3,000. And I'm just going to add them together. 100 times $2,800 plus 300 units times $3,000. And I wind up with $1,180,000 for the first sale. That's my cost of sale. And I'm going to repeat that process for the second sale. Remember to keep in mind that for the 400 units that we had, we sold 300 in the first sale, so we only have 100 left. Remember, we're selling 600 in this case, so we'll grab 100 at $3,000, and then 500 of these 800, we'll grab 500 more at $3,200. Add those 2 products together, and we'll wind up with $1.9 million for the second sale as our cost of goods sold. Add the 2 together, and this will be your total cost of goods sold under the first in, first out method. Next, assuming inflation or rising prices, you want to know the first in, first out inventory value, generally that it will be higher than under the LIFO by the amount of LIFO reserve or allowance. So companies often will have an allowance account that will, if they're using LIFO, that will show the difference between what the inventory value would be on the financial statement under FIFO versus what it is under LIFO. So I have a demonstration of this calculation as well. And here they're going to give you the FIFO value assuming prices, we're going to calculate the FIFO value assuming prices are rising. Well, they give you the LIFO inventory value, and I change it to 18 million. So they'll give you that, and then they give you the LIFO reserve. Again, this is a reconciling account between what the inventory value would be under FIFO and what it is under LIFO. And they're telling you that they have $3 million in that account. So then, if the inventory were valued under first in, first out, it would be valued at $21 million. And we just add together the 18 million plus the 3 million. And we arrive at $21 million. And it makes sense under rising prices because under FIFO, we're grabbing the older, lower costs off the balance sheet every time we make a sale. And what we're leaving on the balance sheet under FIFO are the more recent, more expensive purchases that will increase what's left on the balance sheet. So we'd expect to see a larger balance under the FIFO method than under the LIFO method. We also know when to expense natural resources. So generally, it's like any inventory item, we don't expense it until we sell it. I would know the calculation of LIFO under the periodic method. I have a demonstration for this one. This is calculation of last in, first out under the periodic method, which is a little bit easier in this case than the perpetual method. Under the last in, first out, I just repeated the data that's given in your problem in the exam. I did change the March 5th sales to 500 units. The nice thing about the periodic LIFO approach is you need just to consider the number of units that are purchased and sold in total. And so what I did to get my answer for the ending inventory under the periodic LIFO approach is I took all of my purchases and the beginning inventory in units. I deducted all of the units I sold. And once I took all the units I had available, less all the units I sold, I multiplied that then by $7.20 because under last in, first out, I'm going to record all of these first. So if I have the difference between the purchases and the sales, I know that whatever value that is, in this case, the value of the amount of purchases would be $3,000, the value of the amount sold would be $2,400. I have 600 units left. 3,000 minus 2,400. 720 times 600 units is 4,320, using my numbers. So that's the approach under the periodic method. Take the difference between units available and units sold, and then apply them to the oldest costs available. Next, know the characteristics of the lower of cost or market. There's actually 3 separate questions and relate to LCM. So if you look at the previous notes that I have above, as well as the example that I gave you on how to calculate the lower of cost or market, then you should do well on these 3 questions. So we just know the characteristics of the perpetual average cost system. And you know, for example, under the perpetual average cost system, that you need to recalculate your average cost of the units available to sell every time you make a sale. And oftentimes, if you've made changes to your inventory, like you purchased more inventory since the last sale, then we know under the perpetual system, we need to recalculate our average cost per unit every time we make the next sale. Talked about the LCM calculation, and then know the elements of capitalizing the cost of land. Be sure to include everything that it requires or that's involved in getting the land ready for its intended use. When you capitalize land, for example, if you have to take down a building to get the land ready for its use, that would be included in the cost of the land. Any closing costs that are involved in purchasing the land would be included in the cost of the land. And then finally, know the characteristics of how to determine goodwill. Be created when a business or a division changes ownership. And then we test for impairment on goodwill. In the years that we feel there's been a qualitative change to the company that may necessitate a test of goodwill. So know all of these concepts then and study the demonstrations that I gave to you, and you should do pretty well on the final. Please let me know if you have any questions.